Welcome back to the True Analyst. We try to break down the economics and policies that hit your wallet before the headlines do. Let's start with the number that made every business channel run breaking news last week. In FY26, Indian banks reported frauds worth 48,021 crore rupees. Let that number sit with you for a second. 48,000 crore rupees. That's roughly the GDP of Bhutan. That's more than the annual budget of several Indian states. Gone. Poof. To give you context, just 2 years back in FY24, this number was 11,013 crore rupees. Last year, FY25, it jumped to 32,800 crore rupees. And now, 48,021 crore rupees. That's a 4 times jump in 2 years, a 46% jump in just 1 year. Every business channel ran breaking news on this. Social media was on fire. WhatsApp forward started flying. And your first thought probably was, are hackers stealing our money? Is my UPI safe? Should I stop using my debit card? But here's what the headlines won't tell you. In the same year that fraud amounts jumped 46%, the number of fraud cases actually fell by 57%, from 23,722 cases to just 10,114. So how do you lose 4 times more money with half the cases? How does that math work? And while banks were busy explaining this to the RBI, the central bank quietly changed the rules on July 1st. New fraud liability guidelines. 0 liability if you report within 5 days. Compensation up to 25,000 rupees. Sounds like great news for the average account holder, right? Except, small finance banks are excluded. Payments banks are excluded. Regional rural banks are excluded. And if you miss that 5-day window by even a single day, the liability could shift back to you. So today, we're doing what we always do. We're following the money, RBI Annual Report FY26, Supreme Court judgments, and the fine print of RBI's new directions that your bank doesn't want you to read. No opinions without receipts. Let's begin. Let's go straight to the source. RBI Annual Report FY26, page 174, table 7.2. I went to the source so you don't have to. The headline number is 48,021 crore rupees. But numbers without context are just noise. So let's add context. In FY24, total fraud amount was 11,013 crore rupees. FY25, it jumped to 32,800 crore rupees. FY26, 48,021 crore rupees. That's a 46% jump in 1 year, a 336% jump in 2 years. But here's where it gets strange, almost counterintuitive. The number of fraud cases went from 23,722 in fiscal year 25 to just 10,114 in fiscal year 26, a 57% drop, fewer frauds, more money lost. How does that work? The answer is simple but important. The average fraud got much, much bigger. In FY25, the average bank fraud was 1.38 crore rupees. In FY26, 4.75 crore rupees. That's more than a 3-fold increase in the average ticket size. Fraud didn't become more common. It became bigger, much bigger. And that tells us something crucial about what kind of fraud we're actually talking about. This isn't thousands of small-time scams. This isn't someone installing a skimmer on an ATM in a Mumbai suburb. This is a smaller number of massive, sophisticated boardroom-level frauds involving shell companies, layered transactions, chartered accountants who know exactly how to hide the trail, and promoters who've already planned their exit before they take the first rupee. We'll get to what kind of fraud this actually is. But first, the most important question, is this 48,000 crore rupees actually new fraud, or is something else going on? Because if you understand this one thing, the entire story changes. Let's break down who lost this money, because not all banks are equal here. Public sector banks, your State Bank of India, Punjab National Bank, Bank of Baroda, Union Bank, accounted for 74.5% of the total fraud amount. That's 35,709 crore rupees out of 48,000 crore rupees. Private sector banks, 20.3% or about 9,748 crore rupees. Foreign banks operating in India, roughly 5% or about 2,400 crore rupees. Now, before anyone starts the privatize everything chant, let me add some context. PSBs handle about 60% of India's banking assets. So 74.5% of frauds from 60% of assets. Yes, it's disproportionate, but it's not as dramatic as it sounds on first glance. And let's be honest, private banks have had their own share of scandals. They're just better at burying them in complex financial structures. But here's what really shifts the narrative completely. Where did this fraud actually happen? What was defrauded? 85% of the fraud amount, that's 40,818 crore rupees, came from advances. Loans, credit, corporate loans, project finance, working capital facilities, term loans for infrastructure, where a borrower takes money from the bank, diverts it to related parties through a web of shell companies, over-invoices, under-delivers, creates fake purchase orders, and eventually defaults. By the time the bank realizes something is wrong, the money is in Dubai, London, or Singapore, and the promoter is giving interviews from a yacht. Only 4.2% of the fraud amount came from card and internet fraud. 4.2%. So when you see 48,000 crore rupees bank fraud flashing on your TV screen, your mind immediately goes to hackers in hoodies stealing your OTP, or someone cloning your debit card at an ATM, or a phishing email that tricked your uncle into sharing his PIN. But the reality is, this is mostly corporate borrowers gaming the system. And PSBs are the biggest victims because they lend the most to large corporates and infrastructure projects. They're the ones financing power plants that never get built, steel plants that overstate their capacity, and real estate projects that exist only on paper. This is Nirav Modi territory, Vijay Mallya territory, Mehul Choksi territory. The kind of fraud that happens in boardrooms with lawyers and chartered accountants, not on your smartphone. Now, remember I asked whether this 48,000 crore rupees is actually new? It's time for the Supreme Court twist. In September 2025, the Supreme Court of India delivered a judgment that fundamentally changed how banks report fraud. Previously, banks had some discretion in classifying and timing fraud reports. They could argue about when exactly a loan became fraudulent. Was it when the first diversion happened? When the promoter stopped answering calls? When the account turned NPA? When the forensic audit confirmed wrongdoing? The Supreme Court cut through all of that. It ruled that banks must report frauds based on the date of occurrence, not the date of detection, and it forced banks to go back into their books and re-report old frauds that hadn't been properly classified. What does that mean in plain English? It means banks had to dig into their loan books, look at frauds that happened in fiscal year 22, fiscal year 23, fiscal year 24. Cases that were sitting there, sometimes known to the bank, sometimes suspected but not acted upon, and re-report them in FY26 with the correct classification and the full amount. So of the 48,021 crore rupees reported in FY26, approximately 30,199 crore rupees is legacy fraud, old frauds, re-reported from previous years because the Supreme Court forced banks to come clean. The actual fresh fraud in FY26? Around 17,822 crore rupees. Now, 17,822 crore rupees is still a massive amount of money. It could fund several mid-sized government schemes. But it's not 48,000 crore rupees, and that's the number that should have been in the headlines. But here's why the legacy number still matters. Perhaps even more than the fresh number. 30,000 crore rupees was hiding in plain sight, sitting in bank books, known to bank officials, suspected by regulators, but not reported, not classified, not acted upon. Banks knew about it. The RBI probably knew about chunks of it, but it took a Supreme Court judgment to force it onto the books, into the annual report, and into public view. Think about what that means. For years, 30,000 crore rupees of fraud was invisible to depositors, to shareholders, to Parliament, to the public. Banks were carrying this on their books, pretending these were just stressed assets or divergence in asset classification. Fancy terms for, we lent money to someone who stole it. And that raises a question I'm going to keep coming back to in this video. If banks can't detect fraud in their own loan books, if it takes the Supreme Court to make them admit what was already there, why should you trust them with your savings? Now let's talk about the other side of this story. While banks were dealing with the fallout of the Supreme Court judgment, and while the RBI annual report was making headlines, the Reserve Bank quietly implemented new fraud liability directions, effective July 1st, 2026. These are amendments to the Master Direction on Frauds, and on the surface, they look like a big win for retail customers, for people like you and me. The headline change, and I'm reading this verbatim from the RBI document. In cases of fraud involving unauthorized electronic payment transactions, the customer shall have zero liability if the transaction is reported to the bank within 5 calendar days of the transaction date. 5 calendar days, not business days, calendar days. That means Saturdays, Sundays, bank holidays, Diwali, Eid, Christmas. All of them count. Previously, the rule just said without delay, which is vague, which banks interpreted as whenever you notice, which could mean weeks, which often meant the bank would argue you were too late and therefore liable. Now it's 5 days, hard stop. There's also a second big change, a one-time compensation cover. If you lose up to 50,000 rupees in a fraud and you report it within 5 days, you can get compensated up to 25,000 rupees one time. On paper, this looks like the RBI is finally taking retail fraud seriously, protecting the common man, giving you a safety net. But here's the catch, and it's a big one. Who's eligible? Scheduled commercial banks, SBI, HDFC, ICIC, Axis, Kotak. Yes, but small finance banks, excluded. Payments banks, excluded. Regional rural banks, excluded. Let that sink in for a moment. The banks that serve rural India, small farmers in Bihar and Uttar Pradesh, micro-entrepreneurs in Madhya Pradesh, self-help groups in Odisha, daily wage workers in Jharkhand, the people most vulnerable to fraud and least equipped to navigate the complaint system, the legal system, the banking bureaucracy, they get no compensation cover. RBI's own data shows that rural and semi-urban branches report higher rates of debit card and UPI fraud per transaction than metro branches. But those customers are excluded from this protection. Why? The RBI notification says these directions apply under the Payment and Settlement Systems Act, 2007, and SFB's payments, banks, and RRBs operate under different regulatory frameworks. But that's a technicality. The real question is, if the RBI can mandate this for SBEI and HDFC, why can't it mandate it for AU Small Finance Bank, or India Post Payments Bank, or your local regional rural bank? Are rural customers less deserving of protection? Or is this just easier to implement for large banks with better systems, while the vulnerable are left behind? Before you celebrate the 5-day rule, let me walk you through 3 unresolved questions that the RBI document doesn't answer clearly. Question 1. Who pays the compensation? The RBI document says the compensation will be provided through a one-time cover, but it doesn't specify the source. Is it RBI's own fund? Is it the bank's money? Is it the beneficiary bank's money? The bank where the fraudster transferred your funds? I've read the 47-page draft directions 3 times. The answer is not clear anywhere. If it's the bank's money, will banks pass this cost to customers through higher fees? If it's RBI's fund, where is that fund coming from? If it's the beneficiary bank, what happens when the fraudster has already withdrawn the cash? Question 2. What counts as negligence? If the bank can prove that you were negligent, shared your OTP, clicked a phishing link, used an unsecured Wi-Fi network, didn't update your phone number. The liability shifts back to you, even if you report within 5 days. Now, in practice, what does negligence mean? The RBI doesn't define it. Banks will define it, and banks have a strong incentive to define it as broadly as possible. Did you write your PIN on a piece of paper? Negligent. Did you delay reporting because you were traveling for a family emergency? Negligent. Did you not update your phone number with the bank because you changed jobs and cities? Negligent. Did your elderly parent fall for a convincingly scripted phone call? Negligent. This is the fine print that will decide whether you get your money back, not the 5-day rule, not the 25,000 rupees compensation. This undefined, unbounded concept of negligence. Question 3. What about third-party breaches? You shopped on a well-known e-commerce website. That website got hacked. Your card details were stolen from their database, not from you. The fraudster used them 2 weeks later to make purchases. Is that your negligence? You didn't share your OTP. You used a secure connection. You did everything right. The merchant failed to protect your data. The RBI directions say, and I'm quoting, liability in cases of third-party breaches shall be determined based on the specific circumstances. That's not a rule. That's not a standard. That's a blank check for the bank to decide whatever suits them. And here's the kicker. The directions say that if the beneficiary bank, the bank where your money was transferred, can recover the funds, they'll be returned to you. But if the fraudster has already withdrawn the cash or moved it to cryptocurrency or transferred it to an account in a country with no extradition treaty, then what? The directions don't say. So to summarize the new rules, report within 5 days, maybe zero liability, but only if you're not negligent. And only if you bank with a scheduled commercial bank, and only if the bank decides your case qualifies, and only if the money can be recovered. That's a lot of only ifs for a rule that's supposed to protect you. Now let's talk about that 5-day window in the real world. On paper, it sounds reasonable. In reality, it's a trap for millions of Indians. Only 27% of Indian adults check their bank statements monthly or more frequently. That's from the RBI's own Financial Literacy Survey 2024. 73% of us are flying blind. We don't check our accounts regularly. We don't read SMS alerts. We don't reconcile transactions. And now we have 5 days to spot a fraud, or we might be liable. Let me give you 3 real-world scenarios. Scenario 1, Saushi, you live in a village in Bihar. Your nearest bank branch is 15 kilometers away. You don't have smartphone banking because the network is patchy and you can't afford a smartphone. You check your passbook once a week when you go to the market on Saturday. A fraudulent transaction happens on Monday. You find out on Saturday. That's day 6. You're now outside the 5-day window. The bank can deny your zero liability claim. And remember, if you bank with an RRB, you're excluded from the compensation scheme anyway. So even if you report on day 1, you get nothing. Scenario 2. You're a senior citizen. Your eyesight isn't what it used to be. You don't check SMS alerts because the font is too small and your phone is a basic feature phone. Your son, who lives in another city, checks your account when he visits on Sunday. The fraud happened last Tuesday. Day 6 again. Scenario 3. You're a small business owner. A Kirana store, a small trading firm, a contractor. You have 200 transactions a day. UPI payments in, supplier payments out, staff salaries, utility bills. A fraudulent 8,000 rupees debit gets lost in the noise. You reconcile your books on the weekend. Day 6. The 5-day rule assumes a level of financial vigilance, digital literacy, and access to banking infrastructure that most Indians simply don't have. It assumes you have a smartphone with a banking app. It assumes you check your account daily. It assumes you know what a fraudulent transaction looks like. It assumes you have the bank's fraud hotline saved in your phone. These are metro assumptions. These are assumptions for people who have never stood in a queue at a rural bank branch that opens at 10 a.m. and closes at 4 p.m. with a 2-hour lunch break and is understaffed on the one day you can visit. And here's another layer. What if the fraud isn't an unauthorized transaction? What if it's a third-party breach? You shopped on an e-commerce website. That website got hacked. Your card details were stolen. The fraudster used them 2 weeks later. Is that your negligence? You didn't share your OTP. You used a secure connection. You did everything right. The merchant failed to protect your data. The RBI directions say liability shall be determined based on specific circumstances. That's not protection, that's a lottery. Now, I want to connect the two stories we've covered today because they're related in a way that should make you deeply uncomfortable. On one side, we have 48,000 crore rupees in bank frauds, mostly corporate loan frauds, mostly in PSBs. The average fraud is 4.75 crore rupees. These are sophisticated boardroom-level scams involving shell companies, over-invoicing, related party transactions, and promoters who've planned their exit before they take the first rupee. On the other side, we have RBI's new retail fraud rules, protecting you from UPI scams and card fraud. Average loss, maybe 5,000 rupees to 50,000 rupees. The RBI is aggressively protecting retail customers from small-ticket digital fraud. The new rules cover the 4.2%. The 85% corporate loan fraud goes largely unaddressed. Look at this comparison. Retail fraud accounts for 4.2% of the fraud amount. The typical loss is 5,000 rupees to 50,000 rupees. It's visible, viral, makes headlines, creates public anger. The regulatory response? A new 5-day rule. A 25,000 rupees compensation cover, press releases, media briefings. Corporate advances fraud accounts for 85% of the fraud amount. The average loss is 4.75 crore rupees. It's invisible, buried in loan books, classified as stressed assets or divergence in asset classification. It takes years to detect. And when it's finally reported, the promoter has already moved their money to Dubai or London or Singapore. The regulatory response: no comparable new rule, no compensation for depositors, no 5-day window for banks to report it. Why this imbalance? Because retail fraud is politically visible. It affects voters directly. It goes viral on WhatsApp. It creates outrage that regulators and politicians have to respond to. Corporate fraud is politically invisible. It affects banks, not voters directly. It's buried in complex financial statements that most people can't read. The promoters are often well-connected. The loans are often approved with political blessing, and by the time the fraud is confirmed, the money is gone and the promoter is giving interviews from a beach in a country with no extradition treaty. The RBI's new 5-day rule and 25,000 rupees compensation are good optics. They make the regulator look proactive. They make banks look customer-friendly. They generate positive headlines, but they don't address the systemic problem. And here's the data point that ties it all together. PSB gross NP as of March 2026 were around 6.4%. Private banks, 2.1%. The same banks that report 74.5% of frauds also carry 3 times the non-performing assets. That's not a coincidence. That's a pattern. Banks that are sloppy with corporate lending are also the ones where fraud thrives. Banks that don't do proper due diligence before sanctioning a 500 crore loan are also the ones that don't detect when that loan is being diverted to a shell company in Mauritius. So when RBI issues new retail fraud rules while corporate fraud explodes, I have to ask, is this genuine consumer protection or is it regulatory theater? You decide. But make sure you have the receipts. All right, enough analysis. Let's get practical. Whether you think RBI's new rules are enough or not, whether you believe this is genuine protection or regulatory theater, here's what you should do today to protect yourself. 7 things. Number 1, enable every alert. SMS, email, app notifications, WhatsApp banking alerts if your bank offers them. Don't ignore them. Don't mute them. Don't swipe them away. That SMS you get at 2 a.m. saying 500 rupees debited from your account, read it. It might seem like a small amount, but fraudsters often test with tiny amounts before the big hit. That 500 rupees could be the warning before a 50,000 rupees withdrawal. Number 2, check your account daily. Not weekly, not when you remember, not when your salary gets credited, daily. It takes 30 seconds on your banking app. Look for transactions you don't recognize, even small amounts, even 1 rupee or 10 rupees. Fraudsters test the waters before they drain the pool. Number 3, know your bank's 24/7 fraud hotline, not the branch phone number, not your relationship manager's mobile. The 24/7 fraud hotline. Save it in your phone, add it to your contacts. If you see a fraudulent transaction at 11 p.m. on a Sunday, you need to call that number immediately. Not wait until Monday morning, not wait until the branch opens. The 5-day clock is ticking, and it doesn't care about bank holidays. Number 4, document everything. Screenshot the transaction, note the exact date and time. Save the SMS alert. Save the email notification. If you have to file a complaint, you need evidence. Banks will ask for it. The RBI ombudsman will ask for it. Consumer courts will ask for it. Without documentation, you're just a person claiming something happened. With documentation, you have a case. Number 5, file the complaint in writing. Don't just call. Don't just WhatsApp your branch manager. Send an email. Use the bank's online complaint portal. Get a complaint number. The RBI's integrated ombudsman scheme requires you to first approach the bank and get a response, then escalate to the RBI ombudsman if you're unsatisfied. But you need documentation at every step. A phone call is not documentation. An email with a ticket number is. Number 6, understand your bank category. If you bank with a small finance bank, a payments bank, or a regional rural bank, you are not covered by the new compensation scheme. The 25,000 rupees compensation doesn't apply to you. The 5-day zero liability rule might, but the compensation doesn't. Consider whether you need a backup account with a scheduled commercial bank SBI, HDFC, ICICI, Axis, Kotak for your primary savings and large transactions. I'm not saying close your SFB or RRB account. They serve important purposes. But for your emergency fund, your fixed deposits, your primary savings, know what protection you have and what you don't. Number 7, and this is the most important one, don't share your OTP ever. Not with bank officials who call you. Not with RBI representatives who say your account will be blocked. Not with KYC verification agents who claim they need it to update your details. Not with delivery agents who say they need it to confirm your address. Not with anyone. No legitimate bank employee, no RBI official, no government agency will ever ask for your OTP or your PIN, ever. If someone calls and asks for it, hang up immediately. If someone emails and asks for it, delete the email. If someone texts and asks for it, block the number and report it. That single piece of advice, don't share your OTP, will protect you from 80% of retail fraud. Everything else is secondary. Do these 7 things, not tomorrow, not next week, today. So here's the verdict: 48,021 crore rupees in reported bank frauds. A Supreme Court judgment that exposed 30,000 crore rupees of hidden legacy fraud sitting in bank books for years. And new RBI rules that protect some customers exclude rural and small bank customers entirely, and leave plenty of room for banks to say no through vague definitions of negligence and third-party liability. The RBI's 5-day rule is good consumer protection theater. It generates headlines. It makes the regulator look proactive. It gives depositors a sense of security. But it doesn't touch the 85%. It doesn't touch the corporate loan books where the real systemic risk lives. It doesn't address why PSBs continue to lend to politically connected promoters with questionable balance sheets. It doesn't explain why 30,000 crore rupees of fraud was hiding in plain sight until the Supreme Court forced banks to report it. The data is from the RBI Annual Report, FY26, page 174, Table 7.2, the Supreme Court judgment from September 2025, the new directions from RBY's draft Third Amendment, effective July 1st, 2026, the financial literacy data from RBY's own survey in 2024. Everything I said today is verifiable. Everything is sourced, because that's what we do here. Now, I want to hear from you. Have you ever been a victim of bank fraud? Did you get your money back? How long did it take? What was the process like? Was the bank helpful, or did they find a way to blame you? Drop your story in the comments. The best, most detailed comments, the ones that add real insight, might become part of a future video. And if you found this video useful, if you think your friends and family need to know about the 5-day rule before it's too late, if you know someone who banks with an RRB or a small finance bank and doesn't know they're excluded, share this video, not just like share. Because the person who needs this information probably isn't watching finance channels. They're watching entertainment. They're busy with work and family. They don't know the rules changed on July 1st, and they might be the ones who need it most. If you're new here, subscribe. We break down the economics and policies that hit your wallet before the headlines do every week. Data-driven, receipt-backed, no noise. I'll see you in the next one. Until then, stay vigilant. Follow the money, and always ask for the receipts.